Everybody, I want to make sure that you can hear me and that you can see my screen. It should be the cover screen, Monthly Strategy Gathering, August 2014, Investing When Things Go Wrong. And we're using a different platform this month. I'm test driving it to see how I like it and how you like it. And over on the right, you'll see a handful of different tabs. If you just go to the chat tab, I want to be able to make sure that you can hear me and see me. So I'll wait for everyone to get in. And I don't think we officially start for one more minute. So I'll probably relay that that ask of you to go to the chat section on the tab and just let me know that you can hear me and see my screen. Thanks, everybody, for letting me know you can see my screen, you can hear me. I'm going to give it about 30 more seconds to let more people in. There seems to be, when I start this, about a minute lag. And of course, if you guys have questions about anything that I cover, you can go ahead and ask it in the chat area. I have enabled the messages to be private, so if you have a question, you can just go ahead and type that in. All right, thanks everyone for being here. This is our August monthly strategy gathering. Like I said, pre-meeting, I'm using a new technology platform, so I'm interested to see how it works, both for me and for you. So you can go ahead and let me know in the chat if things are or are not working. But my title is Investing When Things Go Wrong, and I wouldn't quite call it an epiphany, but there's an increased amount of clarity around what I think people really want. And it really has to do with how we invest in asset classes, sectors, individual stocks. So investing when things go wrong, that'll be our overriding theme for this conversation. So we're going to do our strategy review, a 30-day forecast, take live Q&A, and speed investing. And we'll jump into that. So if you have any questions, type them in and type in your ticker symbols too, and I'll get to those during speed investing. So the first is strategy review. We have 3 strategies that we follow. LTEC strategy, long-term economic cycle. Right now we're in cash, and the year return is about negative 1.26%. This long-term picture, we are in a physical cycle. That means gold and silver. Gold and silver are bottoming out, and A can maybe is about to break out of that long-term bottoming pattern, which lasted about 18 months, or it's going to take one more correction down and then move out. So we'll see. The second strategy is market probability. This is very straightforward. This is the probability of whether the market's going to go higher or lower. It is not a timing thing. It is not a predicting thing. We're actually looking at the direction of the market as it's happening, and we're up a little under 6% for the year, including dividends. And the last mode change for market probability was way back at the beginning of 2012, so over 2.5 years ago. And then we have the OT strategy. That's obvious trend. We buy individual sectors and stocks. We buy things that are trending up, but we wait for them to correct, and then we get in. And the return of that strategy is up a little over 5% for the year. Now, if we jump a little bit, and I apologize for this being a little small, but there's 6 positions in the obvious trend strategy, only 6. And I'm actually really proud that with as few as 6 positions, going back 4.5 years, we've done really well beating the stock market. Though this year we're not beating it by much. We're beating it by 0.4 percentage points. But still, the fact that there's only 6 positions with one of the positions being negative is pretty darn impressive. So if any of you have questions with those 6 positions, you can just go ahead and type those in. And the other pretty amazing thing is, of the 6 positions we have, 5 of them are new for this year. So that's also pretty impressive. So I'm pretty proud of obvious trend portfolio. If we look at all 3 of them together, not that you would necessarily want to or have to allocate equal amounts into all 3 strategies, year to date, the 3 strategies together would add up to 4.1% if you were equally weighted in all of them, which is slightly underperforming the S&P 500 for the year. So that's the strategy review. What we're doing is working with obvious trend. We're finding individual stocks that have corrected and are going up, and especially the 2 kind of boring shares that we bought, VKQ, which is municipal bonds, and Annaly. Those 2 have really helped out with the dividends. VKQ, which is municipal bonds, that gives us about 6.6% dividend yield, and Annaly gives us right around 11% dividend yield. So those extra dividends this year have been really nice for us. So those are the strategies. Those are working, and we're waiting for obvious long-term economic cycles, or LTEC, to break out of its bottoming pattern, and then we'll jump back in. So that is the strategy review. The next thing we're going to do is look at the 30-day forecast. And this may be a little clunky as I jump over to the price charts, because I want to jump over to the price charts, and I have them live. So the first thing we're going to look at is the stock market. So what I'm going to have to do is change screens to get us over to the screen that I want us to get to. So I want us to get to price charts. So as far as the overall stock market here, this is the S&P 500. If you look at the screen, you can see that there's this horizontal line here. That's right at about 1,890, and there seems to have been some resistance in March and April and May. It kind of finally broke through. So we're in a little correction right here, and it would not surprise me at all for the correction to finish up right here on 1890, though we've come pretty close. If you look on this intraday, we came with about, I'm going to call that 1% of this, but we could go back down and see if we can hit that. So we're in a little small correction here. Hasn't even corrected 5%, or maybe just 5%. So really right now the direction of the stock market is up. It is very strong. It is I think it is actually one of the best, if not the best performing stock markets this year. Europe is really underperforming. Germany is really underperforming. But that is the stock market. The next thing, and I'm not going to jump back to the slides because it's going to be too much in between, but the next thing I want to look at is the bond market. And I want to pull up the 10-year Treasury yield, the 10-year Treasury yield. So if you look at the screen here, over on the right-hand column, those numbers, it starts at the very top at 30.36, goes to the bottom to 16.14. What you really want to do, and I'm not sure why they don't do this, is move that decimal point one number to the left. So at the top, it should really say 3.036%. That would be 3%. And as you can see, we kind of bounced off 3% at the beginning of the year, and the yield has been falling ever since. Now, when the yield goes down, that means the price of that underlying bond is going up. That means more people are buying the 10-year Treasury. But notice this thing. Notice I'm going to pull up okay, here's the 30-year Treasury. Notice how it's fallen actually much more, yeah, than the 10-year Treasury. That means people are putting more money into the 30-year Treasury than the 10-year Treasury. People are putting more money into the long bond. Now, the reason people would be doing that is because they think interest rates are going to come down. Otherwise, they'd be putting them into shorter-term bonds. So as far as the charts go, the charts are telling us interest rates are going to continue to come down. And this kind of makes sense when you look at the rest of the world. And the U.S. right now, the 10-year Treasury, let me go back to the 10-year Treasury, T and X. The 10-year Treasury is yielding about, let's just call it 2.5%. Well, if you look at any other major economy in the world, Germany, Japan, China, you're going to see these yields much lower. They're equivalent of the 10-year Treasury much lower. That means we're kind of the high-yielding country in the world right now. So that means we have more room to come down, and if we're the high-yielding country, that means people are going to put more money into our bonds, which pushes the price up, which pushes the price down. So over the near term, I see the yield going lower, which may sound really weird, like, oh no, all this money printing, it's got to be inflationary. But right now it's not. It's actually still deflationary. And I think part of the reason is because Europe is in much worse shape than we are. I think a 10-year Treasury in Germany is paying 1%. So you can get 2.5% in the U.S. and get your money out of the euro, and the euro is falling. And we'll talk about the euro when we get to currencies. The next thing, actually, let's jump to currencies right now. So the currency I want to talk about is the euro. Now, this is a price chart of the euro. When you look at the euro, it is compared against a basket of other currencies. The biggest currency it's compared against is the US dollar. It actually makes up 57% of the euro. If I zoom way out on this, you can see that it's been trending down for a while with lower highs, right? So way back here in 2008, the euro hit $1.60, so it cost $1.60 US to buy the euro. And then we moved here into the end of 2009, and it dropped down to about $1.50. Then the peak of 2011, or now I'll say 2011, was about $1.47, and it's just been falling ever since then. And it continues to fall until we get to 2014, where it kind of bounced off or had a peak at about $1.40, a little bit lower than that, but $1.40. So I actually foresee the euro coming down right here to about the $1.18 mark, if not down to parity. And this is going to take time. This is not going to happen immediately. But you can see that 118, which is right down here, is a really strong line. So that's where I see the euro going, having the U.S. only having to pay about $1.18 to buy a euro. And this is going to help the Europe out because they are a huge exporter to the world. If you can cheapen your own currency, the products you export are cheaper to the world. So currencies right now, we absolutely are in a currency war. If you look at the dollar right here, the dollar's had its time to devalue, and it's been kind of going sideways for a while, but you see that the devalue of the dollar really happened at the beginning of the, I guess they call them the aughts, between 2001 to really 2007, 2008, it fell about 33%. It's just been kind of going sideways since then. So the dollar had its devaluation, and now it's the euro's turn to devalue against us, the two major currencies in the world. So they will continue to do that, and that will hopefully, this is Draghi's belief, Draghi is the Janet Yellen of Europe, help out the economies of Europe because they're not really doing that well. So we looked at the stock market, we looked at the bond market, we looked at the currency market. Next thing I want to do is look at the housing market, and I like to bring up the ETF, actually it's a closed-end fund, of U.S. home construction. Price charts tell us a lot, and if you look at this screen, you have all of 2013, you have all of 2014, we go back into almost half of 2012, and I'm going to actually zoom out a little bit more so you can kind of see this. There you go, going back to 2010. Residential construction's just been kind of going sideways, so really not much to report until it breaks below this September low in 2013. To me, it's just really going sideways. There's not much to talk about. But here's the thing. Interest rates are going lower in the United States. That means mortgage rates are going lower. That's a pretty significant thing. If I jump back to interest rates for a second, just look at this for a second. If I just jump back to interest rates for a second, and I zoom way out, you know, when the crisis started back in 07, 08, interest rate, the 10-year Treasury was at 5%. Today it's half that. And everyone buys a house not on purchase price, but what they can afford in monthly payment. So the interest on that monthly payment is in many situations half the size, half the amount. And interest, as anyone who's purchased a house knows, is a significant part of the monthly cost for the first 20 years. So you know, I think housing, and let me jump back to housing, I think housing is going to kind of stay going sideways, and we'll just keep watching it, but it's not breaking down, it's not breaking up, and there's a lot of help coming in from two things: interest rates going down and money from other parts of the world wanting to park some of their own wealth in the US, and it's happening in real estate. Some people even consider Manhattan to be the new Switzerland, where you can buy, because of the laws in Manhattan, you can purchase $1, $2, $3, $4, $5, $10 million apartments and have the title of it be very convoluted, so no one really knows who owns the apartment. It's really the new equivalent of having a Swiss bank account, which I think is really funny, that the U.S. is going after all these countries around the world who are hiding U.S. Residents' money and wealth. And here it is in the U.S. People are dumping hundreds of millions and billions of dollars into real estate where they can hide it from everyone else. So that's actually kind of funny to me. So we've got stock market, we've got the bond market, we got housing or real estate, we got currencies. So for the most part right now, things are going kind of steady. I'll just quickly wrap up going over the stock market again. There it is, going back to 2004. It is absolutely going much higher than I ever thought it would go in this round. But the biggest thing to remember is even as the price is going higher, people are paying less for those earnings. Back here in 2000 right here, people are paying $45 for $1 of S&P 500 earnings. Then here in 2007, they dropped it all the way to $30. So they cut what they were willing to pay by 33%. And even today, with the S&P wanting to hit 2,000, people are paying about $20 for $1 of lifetime income. So that's pretty significant how much it has fallen. And that is the 30-day forecast. Now, I want to quickly bring up one thing before we move on to Q&A and speed investing. I talked about investing when things go wrong. So with market probability, we were out of the market during this time period. Or let me come over here. During this time period, we were out of the market. And we were also out of the stock market during this huge fall. So that's a cycle. When things go bad with the market, we know what to do. I will give you one example, and I'll give you actually a live example with RFP. RFP is a new purchase that we added to Obvious Trend not too long ago. And let me just kind of zoom out here and get you some. So I don't know if your brain can see this, but to me, this kind of goes up and then it falls, and then it kind of goes up. and then it falls, and then I think it's going to go up again. These are cycles. Everything moves through cycles. And I think where the stock wants to get is, I think it wants to get back up to $30 where it was, and is slowly moving its way higher. Now we're actually just about flat on this. Where it was added is about 9 cents below where it is. But as you can see, when it moves down and corrects, it doesn't just move straight down in a linear path and then go straight up. So we're going to kind of have some of that zigzag. But this is what I'm talking about, investing when things go wrong. Whatever went wrong with Resolute Force products and it corrected here, that was an opportunity. Whatever went wrong here, there was an opportunity. And there's many stocks that happen to us. We did this with, I'm going to let the screen catch up here. We did this with Intel when it fell. We did this with Apple when it fell. It happens to almost all these stocks. Here's a company, I'll just MRVL, Marvell. Marvell is a $6 billion company. And look, it's going into a correction here, a really nice correction. And to most people, that will scare them. To me, I see that as an opportunity. It's fallen about 25%. Most stocks go straight up. No stocks go straight up. So if you guys have any questions, let me know. We're kind of in the Q&A section. And what I may do is just jump right over to speed investing. And I'm not going to jump back to the PowerPoint so you see the screen. But let's go ahead and jump over to speed investing. And I have some ticker symbols that came in here. We'll start with the first one here. So the ticker symbol is ECA. ECA is almost a $16 billion company. Pays less than the S&P, so you wouldn't buy for the yield. Had a huge move up in 2014. What is this move up doing? So ECA has been bottoming out. It looked like it probably bottomed in 2013. As far as from a technical point of view, you know what? I actually like it. I think it, and then at the end of 2011, beginning of 2012, then here in the middle of 2013, has moved up. If I delete some of the information from the screen, it did break above its 2012 and pull back. So this looks like a normal after a huge move up. I mean, a 42% move up is pretty impressive. I just want to see what it's corrected here. If you don't own it, you could buy it. Make sure you place a 25% trailing stop loss on it. If you do own it, keep that trailing stop loss, and it's looking good. There was actually a question about RFP that came in. RFP is the newest position in the obvious trend portfolio. Obviously, I'm biased about it because it's in our obvious trend portfolio. But to me, let me zoom out a little bit. To me, it looks like it's just slowly moving up from its kind of mid-2012 low. Moves up, goes to a high, corrects back down, moves to a new high, corrects back down, moves to a new high, corrects back down, and that looks like exactly what it's doing right now. I think I'm wrong. Prices, broke below there, but we're going to keep a nice 25% trailing stop loss on this. So that's a nice looking price chart. Next one is EFR. EFR is a closed-end fund. It's what's called a floating rate fund. That means when interest rates go down, this probably will go down. When interest rates go up, the way that these bonds are purchased is they're purchased in shorter durations. So when interest rates move higher, they can adjust and buy those new higher interest rate products. So the fact that this is making a new low, not a new lifetime low, but it is continuing to go down. Now, this is not me doing technical analysis on EFR. I'm just telling you what this is. It's a floating rate fund. But the fact that this is still moving down tells me that, according to at least floating rate bonds, interest rates in the U.S. look like there's more downward pressure or downward movement than upward. And that's one of the reasons why a stock like VKQ, which is municipal bonds, is actually moving up, stabilizing, and then moving up again. Because when we bought this, it was yielding 6.6% at our purchase price. So if people think yield is going to go down, they're going to get into something like a municipal bond, which, by the way, if you buy this and own in the U.S. and you have it in a taxable account, you pay no federal income tax on that, which is typically anywhere between 25 to 40%. So that 6.6% yield, that could be a 8 or 9% yield for someone, which is pretty nice. Okay, we'll do a couple more stocks. The next one is Sdrl. So oil and gas drilling exploration. This has a huge yield. It's 11%. It's almost a $17 billion company. If I zoom way out, I mean, if I look at it this time frame, it's really just kind of going sideways. If I zoom in, it's still going sideways. But I want to kind of take a bigger picture and step back. And so what I see is a stock that bottomed in '09 with everything else on the planet. And its old high, which was, actually I don't know if that's its old lifetime high, but let me just zoom way out and see if that's its old lifetime high. So its old lifetime high happened in '08. I can go zoom closer back in. So it's been kind of just bouncing around its old lifetime high, spending more time above it than below it. And I think, you know, with it paying an 11% yield, you have time to let it go sideways. And that is, these are pretty big moves. I'll zoom in. These are pretty big moves. I mean, this move down was not trivial, right? I mean, that was a 31% fall. So these are pretty big moves. But because it pays that 11% yield and because it's kind of consolidating above its old lifetime high, I think that increases the safety of owning this. Plus, I like that it's a $17 billion company. I think that's that gives it some stability. Okay, I got one more, and then I'm going to hit the pause button on the speed investing. Maybe two more. So this is CF Industries. It pays a yield larger than the S&P, about 2.5%, $13 billion in size. I know agriculture chemicals have done well. If I look at it from this screen, I like it. It's trending up. It's kind of taking a pause. If I zoom out, I see that it did a correction above its lifetime high here, which was a nice correction. So it's just done a nice move up. If you don't own it, I don't know. I might wait for it to correct more because that wasn't really a big correction here. That wasn't really a big correction there. If you do own it, congratulations. Just keep your 25% trailing stop loss on it. That thing looks pretty good. Caterpillar. I talked about Caterpillar at the end of 2013, talking about how it was consolidating. Actually, let me just move it down off the ceiling here a little bit. How it was consolidating above its '08 high, which I liked. It's still in this kind of trending above its '08 high, but I like when things consolidate above the '08 high. You've heard me say that many times, just like Sdrl, SDRL, the one we just looked at. It's paying a yield more or bigger than the S&P, about 50% bigger, so I like that. If you own it, great. It's a $65 billion, $64 billion company, so I like the stability of the size. If you don't, I'd wait for it to have a much bigger correction than it's had. Okay, and then one more. We're going to go with Walgreens here. Oh, Walgreens. Change some tax strategy on it. Let me zoom in first before we do that. So look, you know I like when things look like they're going bad, when it looks like things are not working. I do not think Walgreens is going anywhere. It's a $60 billion company. If I look at the correction here, the correction is a 22% correction. Very nice. That definitely would catch my attention. It pays a larger dividend yield than the S&P. So look, I like it. Could it fall some more? Of course, but you know what? That's why you buy it. You put 5% of your portfolio in it, depending 4 or 5% of your total overall portfolio. Place a 25% trailing stop loss. and you're set. This thing's going to outperform the market just like it has been outperforming the market for about 2.5 years. So that is really nice. Okay, I'm just checking questions here. That's interesting. Let me just give me a second, guys. I just want to check something with my with the platform here. Yeah, that seems to be working. So let me jump back. I'm going to jump back to our screen. So we did our 30-day forecast, answered some Q&A during it, bonds, real estate currencies, live Q&A, took your questions, speed investing, got through that. Our next conversation is September 9th. Here's a couple things I really want you to take away from this. Any strategy you follow, there's going to be periods where it looks like it is not working. It is not working. One of the reasons why the Obvious Trend portfolio has done so well at the end of this year, will be 5 years that I've made it public to people, is because we're buying strong, solid companies or sectors that have simply corrected or things have gone wrong with them. But guess what? Every sector, every stock, every index on the planet, there's always something that goes wrong with it within its larger uptrending direction. And that's why OT has done so well. And it's just when things go wrong is really where the money can be made. And that's why Obvious Trend has worked so well. And that's why market probability is working too, because we stay out. We stay out when things are going bad. Otherwise, we're in. It's very simple. It's very straightforward. And the reason it's so hard to see is because it's kind of so obvious. But once you do see it, it's hard, not to see it ever again. I want to thank you guys for being here. I may ask you how this new platform went. If you could just email, actually I'll just ask you now, if you would just email Patty, P-A-T-T-Y, just quick and say, hey Patty, platform is fine, platform is horrible, liked it, didn't like it, cut out for 30 seconds. That would help me because I'm always looking for the best things for all of us. You guys take care. You, of course, will be getting my weekend podcast coming up this weekend. If anything should change with any of the strategies, I will send an alert out to you and you will get that. You guys take care of yourself and I'll speak to you then.